Hello everybody, this is Ron Wheeler. I'm the manager of options trading here at VectorVest, and it's my pleasure to bring you tonight's special presentation, Creating Income from Your Portfolio. Now, the first thing I want to talk about is, what is income? What do I mean by creating income from your portfolio? Well, to me, an income trade is one where you can make money even if you're wrong on direction. That's what separates buying 100 shares of a stock or buying a call. When you do those type of investments, the only way to make money is if you are correct in your view of the stock. If you buy a call or if you buy 100 shares of a stock, you only make money if it goes up. Well, what if I could show you a way of thinking that a stock is bullish, placing a trade, and even if the stock doesn't go up, we can still be profitable. We can do it on bullish stocks and we can do it on bearish stocks. That to me is the definition of an income trade. One where you can be wrong on your analysis, yet still be profitable. Now, how do we generate income from investing? Well, income from investing can come in really three ways. Number one is dividends. You buy a stock, the company pays you a dividend just simply for owning the stock. It's a great thing, and everybody should be taking part of that. Here in 2020, dividends are kind of a little bit more at risk with the coronavirus as companies are lowering their expectations and not doing much in the way of outlooks. But dividends are a great way to create income. You buy 100 shares of stock. Every year, the company pays you a certain amount of money for owning the stock. The downside of a dividend, of course, is you still have capital appreciation and capital risk. If the stock goes down $10 a share and you only collect $2 in dividends, well, you're still losing money. Now, another downside of a dividend is it's expensive. You have to actually go out and buy the stock to do it. Now, a second way is to do a covered call, and you could, of course, combine this with a dividend too. You own the stock, and then you sell a call against it. You collect premium by essentially selling somebody the right to buy the stock from you at a certain price and time. That will pay you an income. Now, the nice thing about a dividend and a covered call is as you get paid from those, that also lowers the basis price of what you own the stock for. It's a good thing. Downside is, again, it's very, very expensive. You have to actually own the stock to take care of this. And if the stock has a sudden loss, you're pretty much left holding the bag for that large loss. Now, the third way is the way that we're going to concentrate tonight, and that's by the use of option spreads. Now, option spreads have a lot of good things about them. All three of those are great ways of producing income, but option spreads to me have some of the more substantial benefits. Number one, they're higher probability. We can sell and we can look to an option and get a much bigger space to be wrong than a dividend or a covered call. The second thing I really like about option spreads is they're lower risk. By doing a spread correctly, you are now protected in case a stock drops suddenly 15, 20, 30%. You're going to have a maximum risk that you know ahead of time before you place the trade. And the third thing which I love is their low cost. When you buy 100 shares of IBM or 100 shares of Apple or 100 shares of Amazon to do a covered call, or if you do it in a dividend stock, it's expensive. It costs a lot of money. And again, I'm not saying that you shouldn't be doing that. Those are great ways to produce income. But a spread has a much, much lower upfront cost. And as I set the spreads up in tonight's presentation, you'll see exactly how that's done. So to generate that consistent income, we want to combine those three principles. So the first thing I want to talk about is I want to talk about high probability. How can we create a high probability situation? Well, there's two guides to this. There's two ways we do this. We use market timing, and then we use the built-in statistics of options. So let's start off the bat with market timing. To stack the probability in our favor, we trade in the direction of the overall trend only. Now that limits you quite a bit as well, because if we're in a downtrend, we're only looking for bearish stocks moving in a bearish direction. If we're bullish, we only look for bullish stocks moving in a bullish direction. That reduces the time it takes you to establish trading opportunities as well. One of my favorite market timing signals in VectorVest is the DEW, and this is how I base all of my income trades. From February 24th to April 6th, the market timing suggested we were down. I think we all agree we had a good downward move there. Well, on April 6th through the current date, we are now in a DEW up. So from February 24th to April 6th, we were doing bearish only trades. And from April 6th to current, now we're doing bullish trades. So that's the first way. We put market timing in our corner. That alone helps us create a higher probability scenario. Now we're going to layer another stack on this. We're going to use options built-in probability to establish an even higher percentage in our corner. Okay? We're going to use the built-in probability of an option. So let me explain how this works. When you buy a stock, or if you were to buy a call, think about it, right? You get a 50-50 chance of making money. The stock either goes up or the stock goes down. Now, what we are going to do is we are going to use an option here. So if I am bullish, we are going to sell a put. Why are we going to sell a put in a bullish market? Well, because as the market or the stock goes up, if I sell a put for, let's say in this case of Apple, $670, watch what happens to that put as the price of the stock goes up as you get closer to expiration. You start becoming very profitable very, very fast. And I want you to think about this if you've traded options before. If you thought a stock was going to go down, you buy a put, right? What happens if the stock didn't go down and it goes up? That put that you bought, maybe you bought it for $1,000. Now it's worth $900. Now it's worth $800. Now it's worth $700 because the stock direction's wrong. It's going up and not down. Well, as an option seller, if I sell somebody a put and the stock goes up, when that option decreases in value, I'm the one that makes money. So in a bullish market, we sell puts. Now, what we're going to do is we are going to target a probability of 40% or less. Now, what that means is this. If I sell an option that has a 40% chance of going what's called in the money, okay, that means that I have now established a trade that has a 60% probability of going in my favor. That is the equivalent of basically buying a bullish stock at $204 a share for $195 after the fact. Because at expiration, you have a 60% chance of being above $195 and only a 40% chance of being below $95. Now, in a bearish market, we kind of flip the script. If we think that Apple will go down in price, we sell a call against it. Now, why do we do that? Because as the stock goes down in price, the price of our call starts to decline. Now, if we sold the call, that's a very, very good thing. Now, again, take this back to option basics. If you are bullish on a stock, you buy a call. Well, if you're wrong on direction, the stock goes down, that call that you bought loses value. Well, as the seller of the call, you're the one that's making money. And we're going to do the same thing. We're going to target calls that have a 40% or less chance of what we call getting hit. That means at the expiration of that option, there is a 60% chance that this stock will be below 215. And the stock currently is trading for 204. What that means is this. That means over the next, in this case, 20 days, 30 days to expiration, as long as the stock goes and stays below 215, you make money. If the stock goes sideways, you make money. If the stock goes down, you make money. As long as the stock stays below 215, in this case, you will make money. Now, I mentioned earlier that that's a built-in value or a built-in statistic of options. This is based on the historical movement of the actual stock itself. It goes back and looks typically over a 45-day period and annualizes it, and then it tells you based on the price of the option. For instance, I have a grab of IBM at 121. If I were to sell a 127 call, IBM has a 39% chance of going above 127 over the next 21 days. Well, by selling that call, I am generating a trade that has a 60% probability of paying me. And we can go down further and further. If I go to a 130, that means that IBM has only a 34% chance of going above 130 by expiration. That's about an $8.80 move. This is how we gauge it. Now, why do we look for 40% or less? Well, it's the perfect balance of probability gives us a 60% chance in the trade, and also risk reward. We'll look at that a little bit later. A lot of people, when they do these types of trades, they say, oh, well, I'm going to get 90% probably, 100%. The problem is by doing that, you're taking on a huge monetary risk, and we'll bring that up a little bit later as we continue to build. The other thing is, when you combine that with market timing, it increases the probability even more. So by selling an option that only has a 40% chance of going in the money, when you combine that with market timing, you're actually adding to that. We've known historically that can add it up to 70% when you combine it with good market timing. Now, options also have an expiration date. So we need to establish, we know that we want to sell options that have a 40% or less in the money percentage, but now we need to know what option to actually sell. What expiration? Well, I want to talk a little bit about this. If you didn't know, options have kind of a built-in decay. As they get closer and closer to expiration, options lose value faster and faster. So what you're seeing on this graph is a 180-day or a 6-month look. 6 months away from expiration, this option has a value of 70 cents. As you can see, as you get closer and closer to expiration, it starts to go down dramatically. Well, it takes about 135 days for that option to lose 50% of its value. And in the last 45 days till expiration, it loses the remaining 50%. Now, as an option buyer, this is your enemy. But as an option seller, this is our way of making money. We are going to focus on options that lose their value quicker. The reason why we do this is because if we're wrong on the trade, that time decay will work in our corner. It's basically running out the clock for us. So remember, if you're directional, if you think a stock will go bullish or bearish, you want the market to be directional to make money fast. So if I think a stock will go up, the faster it goes up, the faster I make money. If I think a stock is bearish, the faster it goes down, the faster I make money. Time decay is your bonus. It's what helps you make money if you're wrong. If I think a stock is bullish but it goes sideways, I make money on time decay. If I'm bullish and the stock goes down in price, I can make my money on time decay. We put this in our corner. Okay? So what we're looking to do primarily here is selling options that have a 40% or less probability of finishing in the money and something under 45 days. Now, control the risk. You want to stay consistent, right? It's like wearing a seatbelt. We don't wear a seatbelt because we think we're going to get into an accident. We wear a seatbelt just in case we do. Now, as an income trader, the biggest enemy you have is to take a loss that exceeds the average gain. So if I'm making $500 on every winning trade I make, I can't have a trade that I lose $5,000 on. One bad trade can wipe out a bunch of winners. And if you've ever been an option seller before and you've had that happen, it's not your fault. You just didn't know how to put that trade together properly. So let's learn how to do it. But first, let's talk a little bit about risk altogether. As an option seller, right, we are not going to sell what's called a naked option. Naked options, when I sell a naked put, it requires me to have a substantial amount of capital or a very high level of options trading. We don't want to do that. We want to create a system that most people and almost everybody can take advantage of. Now, a traditional option selling system, when you're selling naked options, leaves you with a ton of risk. In a bullish market, remember, we're going to sell puts. So if I sell a 135 put on this stock, and let's say the stock gaps down to $100, I may have the obligation to buy the stock at 135 and now it's trading at $100. That's a huge risk. Well, if you're bearish, it's really the same idea, right? If I sell a call on United Airlines at, let's say, $30, and all of a sudden a bailout happens and now United Airlines goes back up to $70, I have the risk of having to sell stock at $30 a share when it's $70. It leaves you as a naked option trader to tremendous risk. And also, by the way, I won't talk much about this today, but volatility is a huge risk. We've seen in the last month here, month and a half, 30-year highs in option volatility. If you're a naked option seller and volatility goes through the roof, you just got killed. You lost a ton on volatility alone. Well, the paycheck system not only shrinks your risk down to this, it also protects you against volatility. So let's see how this works. I'm going to kind of walk you through a historic trade that I've took in the past. This is a typical stock I'd be bullish on, so it's a good bullish graph, rising in price with the market at the time. So traditionally, what would you do? You'd buy the stock here, right? You'd buy a call. Well, we don't want to do that. We already know that we want to shift probability in our corner. In a bullish market, we are going to sell a put. Now, when we sell a put, we're going to receive premium. In this case, $1.78 or $178 per option contract. Well, the problem is that still leaves you exposed to all that risk. Selling a put is the obligation that you are going to buy the stock at $135 if called upon to do it. Now, quick note, in all of my years as an option seller, I have never been called upon to actually perform a stock transaction. I'll explain that to you a little bit later when we get into the management of this, because it shouldn't happen. Now, again, if the stock goes down to 100, I may be called upon to buy the stock at 135. Now I've got a $35 loss. That can't happen. What we need to do is use what we call a built-in protection plan. We are going to use the premium that we collected, that $1.78, and we're going to use a portion of that to buy a put as insurance. Now, what that does is that locks in the risk. Let's say this stock has a tremendous move down to $100 overnight. You may be left holding the bag by buying the stock for $135, but now you have the right to sell it for $130. You've now decreased your risk down to $5 a share. Now, it's also what's called a credit spread. So you're technically getting paid to place this trade. You will get money deposited into your trading account in the tune of 96 cents. Now, it's not 96 cents, by the way. It's 96 cents per share. One option contract, 100 shares. You get paid $96 to perform this transaction. And this transaction is done simultaneously. It's called a bull put trade. Now, 96 bucks, big deal, right? Well, if you did that on 10 contracts, you can collect $960. If you did it on 20, $1,800. Well, more than $1,800, but you can do the math. Okay? Now, by purchasing a call as protection when you're bearish, same idea. It can reduce your risk down, in this case, to $5. If United Airlines had some big sudden move up to $80 a share, yes, you have the obligation to sell stock at $30, but now you have the right to buy it at $35. You've protected yourself in that bearish trade. Now, that's the first part. We don't want to have unlimited risk. The second thing that we do to control the risk is we look at the trade's risk to reward. Now, this is how it works in a credit spread. It's always going to look like this. So you're going to have your mind wired a little bit differently to do this type of income trade. Now, let me show you an example of a bad trade. This trade has a maximum reward of $23 and a maximum risk of $477. I want you to think about that. Let's say you are 90% right. Every time you make money, you make $23, and every time you lose $477. This is not good. If you want a general idea of how risk reward should look, this is how the risk reward should look on a trade. In this case, my maximum reward is $1,440 and my maximum risk is $2,560. Now, that sounds bad, right? But this trade has an 87% chance of going in your favor. And as I show you in the next part here, your true risk is not that max risk. In fact, in over a decade of doing these income spreads, I have never suffered a max risk in the trade. Okay? Now, in order to lock that in, to have that not happen, you got to be not greedy here, and you got to manage the trade correctly. So don't be greedy here. Don't be chasing bigger and bigger gains, because if you're not careful, those gains that you once had could evaporate. It's kind of like the old show Deal or No Deal, right? They go all the way up to $1 million, and they're answering these hard questions. They could have ended at $50,000 and just walked away. But no, they're greedy. They want that $1 million. But probability is not for them to make that money. So let me talk a little bit about how to manage the trade. Number one, you exit these trades, and these are trades, by the way. They're trades. We exit at 50% profits. Okay? So I'll give you an example of a trade that I took recently. I'm going to walk you through how I did this trade as well. This is a trade on Teladoc, okay? TDOC. Now, this trade has a $150 maximum profit. If I see that the trade has a $150 maximum profit, my actual profit target is about $75. Now take a look. This is a risk graph. In order for me to make all $150, the stock would have to go up basically $100 a share. But by 50% to make $75, the stock only has to go up about $8 or $9 a share, maybe 10 or 12 at the most. By taking profits early, I'm increasing my probability and actually making money. History and backtesting has showed this. By taking profits at 50%, you will make more money in the long haul. Now, what happens if a trade goes against you? Well, remember how earlier I talked about the max loss? And this is another example of a trade that I'm going to work through you guys with a little bit later on United Airlines. I had a United Airlines trade. This is during the market free fall. It had a maximum profit of 141 and a maximum risk of 359. Now, I want you to follow this dotted line. I will exit United Airlines if the stock goes above 65. This was a bearish trade. I wanted the stock to go down. If the stock were to increase in price instead, my stop point is at $65. I never let the option go in the money. Now, what is the true profit and loss of this trade? You're looking to make about $70 with only a $76 risk. And as long as the stock stays below $65 all the way to expiration, you will make money. If the stock goes down to about 54 or 55, you will make profits and be out of this trade very, very quickly. Now, take a look at that dotted line, because even if the stock had some sort of dramatic move and it opened up at $75 the next day, you're still only risking $200 here. The chance of you making a maximum loss are remote. And like I said, I've never taken a max loss on any of these trades. All right, so you got some examples. You got some idea now of what to do. What I want to do next is I want to build some trades with you. I want to actually go back to real trades that I did with my clients in my coaching plan during the market, not only free fall, but then also during the late rally that we've been in. So first off, I'm going to show you some things that I did when the market was in that DEW down from February 24th. Now, these next screen captures, by the way, are from my recordings from my URS, my Ultimate Retirement Solution coaching plan, where we concentrate on these types of trades for income. So this goes back to March 2nd. It was 2:15 p.m. and I run some of our more common scans. Now, all my clients get these scans. This happened to be IG plungers. In IG plungers, it came up with United Airlines. Well, what we do then is we take a look at the stock. Is that stock moving down in price? Well, not only was United Airlines moving down from the market sell-off, it had actually been moving down for quite a bit of time. That's the kind of trade that I'm looking for. Now I go into my option probability. I look at my option probability knowing that I want to sell a call, and I take a look at that ITM column. I'm going to look for a call that has less than a 40% chance of going in the money. And that can be 62.50, that could be 65. Any of these numbers here have a less than 40% chance of going in the money. So I start modeling the trade. This is the first trade I modeled, a $70, $75 call spread. I didn't really like this trade, and here's why. If I look at the credit over here, yes, it has a 78% chance of going in my favor, but I thought the credit and the risk was a little too rich for my blood right now. It would have been about a $42 profit target with a risk up here of about $100. That's a little bit too rich for my blood. So I settled. Remember I talked about how you can sell further out of the money options and get more probability, but the risk gets greater? I settled. I compromised. Instead of doing an option at 70, I sold an option at 65. Now what that gave me was a 25% chance of having this trade go against me, so a 75% chance of success. And at that $65 stop, I only had about a $76 risk. $70 in profit potential with a $76 risk and a 75% chance of success. That is income. Now, what happens if the market moves back up? Now, don't worry, I'm going to show you the outcome of both of those trades, or that trade. On April 6th, the DEW turned back up. So I use one of my scans, Russell 2000 RT, which I've kind of modified a little bit to make a bullish scan. I sort by RT descending. And now I get IPHI, Teladoc, QDEL, EVBG. Well, out of those 4 stocks, I look at the graph. Teladoc, even when the market sold off, really was not selling off. It was a good uptrend all the way through. It had a little bit of volatility in March, but it's been a very good stock. Well, this is bullish. So now I'm going to go to my options and look for puts to sell. I go out there. I have a 32-day option. Here is my ITM category, and I just basically go right up the list until I find something that has less than 40%. I model that trade, and guess what? Here I am. I have a 135 put that has a 32% chance of going against me. So this trade has a 67.3% chance of success. Now, another thing I liked about this trade at the time, I had, look at that, the stock's at 154 and I will make money as long as it stays above 135. Now, if it goes to 135, I'm risking about $90 a contract here. My profit target is 75, my loss is 90. If I'm 75 or 65% right on this trade, I'm going to make money overall. So just to kind of show you how this worked, I placed that trade on United Airlines earlier. We placed that trade on March 2nd at about 247. I sold the spread for $1.39, and I exited the trade at 9:31 in the morning on March 6th for actually 36 cents. I made more than 50% because I had a target and I had an order laying in the market already. Well, the market that day, take a look, it gapped down tremendously, and at 9:31, my order got filled. I didn't have to do anything. It was completely hands-off. Teladoc, same idea. On 4/13 at 2:39, I placed that trade. I sold it for $1.50, and then the trade was exited at 2:09 on 4/15 for 75 cents. So essentially what I did on that trade, I sold 10 contracts. I took in a credit of $1.50 or $150 a contract. I brought in $1,500 in premium. I exit the trade 2 days later, and I essentially pay the market $750 to exit the trade. Well, I got paid $1,500 to enter the trade, and I paid $750 to get out of the trade. That leaves me with a $750 profit. That's how we create good income. And this is just a snippet of some of the trades that we did during that market free fall. $1,100, that happened to be the United Airlines trade. $900, $1,230. A lot of these trades were trading the S&P 500, which we love to do. So in a time when the market went down 30%, I based this on $100,000 in capital. We actually made about 6% during that market free fall. That does not include trades like I just showed you on Teladoc that we did that were more bullish. This is how you create income. You form a trade that has a high probability of success and a limited risk. Now, if this is something that intrigues you and interests you, we are launching in May our next version of the Options Paycheck class. It is delivered both live starting in May and recorded, so you don't have to view it live. You can watch the recordings of it. It's a week-by-week course. This is the Options Paycheck. In Module 1, I talk about basic option information, so those of you that are newer to options have a good foundation. In Modules 2 and 3, I talk about how you can place bullish trades, bearish trades, and neutral trades, how to set them up properly, like I did on UAL and Teladoc. Module 4 goes into how do we actually find the trades, market timing, stock selection. I introduce you to some of my scans that I use here in VectorVest. In Module 5, we talk about setup. We talk about volatility, high probability. In Module 6, I talk about the things that I can do to repair or mitigate damage of a losing trade. I talk about risk and reward. I also talk about portfolio allocation. I have $100,000. How many trades should I have on? How many contracts should I trade? And then also in Module 7, I talk about the broker. How do we go to the broker and make sure that we're placing the trades properly? Now, a couple bonuses I give. That is a value of $19.90. I also offer 7 live mastery support sessions. These are week by week, and they're basically a gathering that we can get together and go over what we talk about in each module. I want to make sure that you understand as you're going through the curriculum. I also give our private Facebook community. We open that up to all of our new attendees. It's a place where you're going to be in there with other people going through the curriculum and course. We can interact. You can ask me questions. I also do 12 months of live Q&A sessions in our alumni forums to kind of keep you abreast of any kind of market changes. Now, I mentioned earlier that some of those trades I told you about when the market was selling off, and even when the market's rallying, were S&P trades. I have an S&P Paycheck specific system. So if you don't want to spend a lot of time finding trading opportunities, I can teach you what's called the SPX Paycheck. One trade, one ticker symbol, one setup rule, one profit rule, one stop criteria. Very, very easy to implement. I also give you 7 weeks access to my members-only group coaching. I mentioned earlier that those screenshots were actually from my live mentoring and my live group coaching. This is where I talk about the weekly trade recommendations, how to find trades and manage them in real time. And it's basically targeted help where you need it. You will be invited as a guest to those where you can watch me do this in real time so you can see how I'm actively implementing this income strategy. For those of you that don't have VectorVest or maybe are on trials, we also give you VectorVest and our Options Pro software to use during the 7 live weeks of the course. Now again, if you don't have those, we'll give them to you. They're not mandatory that you use those Options Pro specifically after the course. You can do what we do in broker software. Options Pro is just a very, very quick tool for speed and efficiency. That gets started the first day of your class. So again, just a quick reminder here of what we got. 7 weeks course, 7 weeks, it starts in May. Give me that 7 weeks, I'll show you how to implement this income system, even if you've never traded options. So there's a summation of what we talked about, the Options Paycheck course. All those modules are taught live. If you can't view the live, it's no big deal. We have recorded sessions as well. 1 year access to all the digital content, the mastery support sessions, the Options Pro software, the members group coaching, the private Facebook, the SPX. If it's something that you're interested in, you can go to optionspaycheck.com, click register. It's a special price on a special early bird price of $9.95. Sign up today. It's a great way to create a second income stream. Now, one thing I also do want to make mention of, we do have a 100% money back guarantee. If you do the course, watch the videos, do the work, if you don't feel like this is a system that's been working for you or could work for you, I will give you your money back. Okay? So the risk is all on my part. I truly feel that this is a system that everyone should be implementing in their portfolio. So again, if you're interested, class starts in May, optionspaycheck.com to register for $9.95. Thank you all for the special presentation tonight and watching. I appreciate it. Best of success to you here in 2020, and stay safe, everybody. Thanks once again.
Thank you for taking the time to watch this video. Now, if you're new to the software or would like refresher information about the software, click on this Getting Started video right here. Thanks to all of your input, here's a YouTube video that we think would be perfect for you. Click right here. If nothing else, folks, just hit the subscribe button right here.